Hey, what's up YouTube? It's Dave, back with Military Money Mastery, and today we're going to be going over ETFs and index funds. This is super exciting stuff. I'm really excited to bring it to you. It's actually like a lot of really good investing. So it's something that's super important to me as far as getting the knowledge to you guys, and I hope you guys really enjoy it. We're going to start off today by going over, what are ETFs? So first off, ETF stands for Exchange Traded Funds. So an Exchange Traded Fund, or ETF for that matter, is a bundle of securities, which are stock companies, that you can buy, hold, and sell through a brokerage firm or stock exchange. ETFs are offered on pretty much all asset classes, from tech to real estate to even commodities. And this is something that I'm super invested in. This is actually my biggest position is in an ETF. As you can see right here at the bottom right of the screen, I even pulled up one of the ETFs that I'm invested in. This one's called FTech. It's a tech industry, and I'm an ET, I'm pretty involved with the tech stuff. So it's something that I feel that I have a good knowledge on. And it's a conglomerate, or not a conglomerate, it's a big holding of a bunch of different companies. So as you can see, it's got Apple and Microsoft, Visa, Intel, Cisco, Oracle, Adobe, MasterCard. It's even got Facebook in there, when Facebook's doing good. So that's something really cool that I like to invest in, and ETFs are really cool. So in my personal opinion, ETFs are one of the most important and best investing options for a vast majority of people. There are tons of benefits to using ETFs, like I explained, being in the tech industry. An ETF is bought and sold like traditional company stock. You can just buy 1, 2, 3, 50, 100, 200, 1,000 different positions in an ETF, like super easy like that, and you can buy them on the market. You can buy them on the open. You can buy them on the close. You can buy whenever you want. You can even set limits for these, which is really cool. So let's go over what index funds are. An index fund is a type of mutual fund with a portfolio that is constructed to match and or track companies of a market index. For example, S&P 500, Dow Jones Industrial Average, etc. These are supposed to provide a broad market exposure with relatively low operating expenses. So that's pretty cool, right? And as you can tell, I have a picture of Warren Buffett here on the screen. He's one of my favorite investors, and he even recommends indexes. He says by periodically investing in an index fund, the know-nothing investors can actually outperform most professional investors, which is huge. That's really big. If a fund can outperform most investors, like why wouldn't you get into it? They're pretty inexpensive. So indexing is a passive form of fund management and has successfully outperformed a majority of actively managed mutual funds over the past. So some of the most popular index funds are the ones that track the S&P 500. Wait a minute. This sounds kind of familiar to me. Does this sound like the C fund to you guys? Oh my gosh, it's exactly like the C fund. Anyway, so as you can tell on the screen here, we have a snapshot of one of the S&P 500 index funds. This is actually SPY 500. So you can see the companies on there, which is kind of cool. So it shows, Microsoft, Apple, Amazon, Berkshire Hathaway, Johnson & Johnson, Google, all types of huge companies within the S&P 500. So it's something that actually tracks it. So this is a really good way to watch what the C fund is doing. Like I said, Warren Buffett recommends investing in index funds for your retirement. So if he recommends it, maybe you should do it. This is something that he really stresses on for like average investors, which I'm an average investor. I'm not like a professional or anything. This is something that I just do for a hobby, right? So what's the big difference between the two? Because there are a few differences. So an ETF is a fund that tracks a sector within the stock market. Let's make that clear, a sector within the market. And an index fund, it tracks the entire market. So it tracks like the entire S&P 500, the Standard & Poor 500, or the Dow Jones Industrial Average, stuff like that. Basically, an ETF is a type of index fund, while an index fund is typically more like a mutual fund. ETFs are a lot more flexible, and because of this, they really appeal to a broad market of investors. Most passive investors actually prefer using ETFs. That's this guy right here. I'm one of those passive investors, I promise you. I'm not day trading. So for example, ETFs can be purchased in smaller sizes, so they also don't require special documentation, special accounts, rollover costs, margins, none of that BS. Also, some brokerage companies actually offer no commission ETFs. I know, crazy, right? Fidelity actually has quite a few. I don't know about the other firms because I use Fidelity, and they're actually really good ETFs. So that's something that I'm actually really passionate about, and the whole being able to buy in small quantities really benefits me because I don't have a lot of money. I've been doing a lot better over the last couple of years as far as money goes, but I still don't have a lot of money. I put a few $100 here or there into an investment account every couple times a month, and I don't have like huge amounts of money just to dump into an index fund. So it's really good to be able to buy one or 10 or 15 different positions within an ETF like that. So something that's really cool about index funds is they actually don't need a brokerage account or deposit account, which is really cool. So they can usually be purchased through an investor's bank, so you can go to your bank and get them. I know USAA has them. This keeps things really simple for investors, and this is something that a lot of people really overlook, the simplicity of it. You don't have to have a brokerage account. Not that brokerage accounts are really that expensive. I got mine for free through Fidelity. I think I got a TD Ameritrade one for free too, just to see what the difference was. So, that's something to take into account. So ETFs and index funds each have their own particular advantages and disadvantages when it comes to costs associated with index tracking and trading. If you can tell here, you see at the top we have the SPY 500. So it actually says it's an ETF, but it's really an index fund. And then at the bottom you can see FTech. That's my biggest position. So you can see the difference in net expense ratios. While it's not overly high, we're talking about 0.01%. 0.0105% if you want to be technical, that can really add up, especially when you're talking about like $1 million or even more than that, and hopefully I will have that by retirement time. I'm on pace to do that, so that's something that can really add up in the end. And while it's not huge, it can add up. So typically, the choice between ETFs and index funds come down to the most important issues, which are the management fees, like your net expense ratios, shareholder transaction costs, taxation, and tons of different other things. But personally, I think the quality of both of these are really good. I like tech. I'm kind of a techie guy, but I also like the S&P 500, and I have a lot of faith in the American economy. So putting money into an S&P 500 fund is great. And actually do it all the time in the C fund, right? So let's go over to risk. Just like any investment, there is risk. I stress this all the time. There is risk involved with investing, no matter what. Warren Buffett, even acknowledges that there's risk. However, there's very good ways to mitigate the risk, especially when you know what you're doing and you take your time and you study and you figure out what you're going to invest in. So you don't have to time the market, but you need to understand it, right? And that's something that I kind of stress. We need to understand what we're investing in. Don't just throw money at something blindly, because that's never going to work. In my opinion, these funds cover a much broader spectrum of markets, which actually makes it easier to watch. It's just so much easier just to watch the entire market than to laser focus in on just one company, just to learn everything there is about that company. And if you do get into one of these big funds, it's actually a pretty good diversification. When I showed you the FTech, it's got Apple and Microsoft. It's like, those guys are always, battling against each other, but it's got both of them, right? So if one does good, the other's going to do bad. So it kind of evens out, or, a lot of times both of them both do good. So that's something really good to check out as well. So let's go over, how can this help my TSP? Can it really help the TSP? I don't know how this... I'm gonna stop right there. This can absolutely help you with the TSP, 100%, no questions about it. And why can it help with the TSP? you know, like I said earlier, index funds are actually almost exactly like TSP funds. I say almost exactly like because, you know, there's going to be slight differences here and there. Different companies are running them. So the TSP is typically cheaper as far as net expense ratios go. So that's a huge plus for us. So knowing that what certain indexes are doing, like the SPY 500, which covers S&P 500, which, like I said earlier, is just like the C fund, right? Something that we've talked about. And it's a great way to get an idea about what the C fund is actually doing, right? So likewise, there's a bunch of different indexes that follow, you know, like the S and the I and the G and the F funds. They don't follow them exactly, but you can find them. There's tons of index funds out there. There's a lot of them that are following Dow Jones Industrial Average or, you know, international markets. So that's something that's really cool that you can get into too. All right, so thanks guys so much for tuning in. I really appreciate it. I kind of want to give a little snippet here. So future episodes, I'm actually leaving for school on Sunday, and I'll be gone for about 4 weeks, 3 to 4 weeks, depending on how well I do. So this means that the format's going to be slightly different over the next couple of weeks. I'm going to try and get as many videos out as I can, and hopefully it's going to be a lot easier, less distractions, you know. But that being said, I'd like to give you guys a background on my life. So my investing life, more specifically. I'm not going to bore you guys out about how my childhood was, but so I want to tell you guys a lot of the mistakes that I've made in the past, what I've done to correct them, and really where I came to be as far as an investor goes. Something that I think could really help a lot of people, and something that can really you know, hopefully motivate some people into learning investing as well. Anyway, I've been Dave from Military Money Mastery. Thank you guys so much for tuning in. I'll catch you guys in the next video.